The letter said his life insurance coverage would end in 60 days. His bank statement said every payment had arrived on time. Alex read both twice at his kitchen table. 18 years of automatic withdrawals, $400 a month, same date, never late, never skipped. $86,400 without a single gap. And a notice from his insurance company explaining that his $500,000 policy would terminate unless he sent more money before a specific date. He was 55. His wife was in the next room. His son was starting his second year of college. Alex had missed exactly 0 payments. The coverage was about to disappear. He kept reading the letter, looking for the mistake. There wasn't one. Next to it, he laid out his bank records. Every withdrawal cleared. Under those, the most recent policy statement. He had filed it in the kitchen drawer without reading past the first page, the way he had filed all the others. And beside all of it, a photograph from the year he bought the policy. 2 kids on a porch step. Him, younger, squinting into the sun. Everything in front of him. Said he had done what he was supposed to do. The letter said it was not enough. Which raises a question that sounds impossible. How does a life insurance policy fall apart while the owner is still paying? Go back 18 years. Alex was 37. He and his wife had a mortgage that felt reasonable on good months and heavy on bad ones. Most of the income was his. He had done the arithmetic a lot of parents do late at night without telling anyone. If something happened to him, the mortgage did not stop. He wanted a number big enough to cover the house and leave something for school. $500,000 felt right. So when a licensed agent came by, Alex was not being talked into anything. He had already decided he needed coverage. He did not know what kind. They sat at the kitchen table. His daughter's crayons were still at one end of it. The agent moved them aside, opened a folder, and drew 3 circles on a legal pad. The first was protection. $500,000 in permanent coverage, designed to last beyond a 20-year term policy if it remained properly funded. The second was cash value. A part of what he paid would support an account inside the policy, and that account could receive interest credits linked to a stock market index. Not invested in the market, linked to it. Under the strategy shown to Alex, a falling index would not produce a negative index credit, although policy charges would still apply. The third was access. That cash value was money he could borrow against later, for a roof, for tuition. Nothing in Alex's story proves that the agent committed fraud. He answered questions and never promised Alex would get rich. He described real features of a legitimate product people buy for real reasons, but the benefits received more time and attention than the assumptions, charges, and long-term risks. That imbalance can happen in complicated financial sales conversations. Here's what Alex actually bought. Indexed universal life insurance is permanent life insurance. There is a death benefit and an account inside the policy that holds value. Every month, the company deducts charges from that account. Some of the money covers the cost of insuring his life. Some covers administrative expenses. The contract describes those deductions. Interest credited to the account may be based partly on an outside index. Alex does not own the index or the stocks inside it. The contract uses index movement as a measuring stick, and the credited amount can be limited by caps, participation rates, or other contract terms. And the premium is flexible. He can pay more in a good year, less in a tight one. That word, flexible, is the one worth holding on to. Flexible means the company will accept different amounts. It does not mean every amount will work. Then came the illustration. It was thick. Columns of numbers running down the page year by year from age 37 to 100. 2 sets of columns. One showed guaranteed values, calculated using the worst crediting and highest charges the contract allows. That column looked bleak. The other showed projected values, assuming the account earned about 6.5% every year for the rest of his life. It showed the account growing past $60,000 by his mid-50s. Coverage lasting as long as he did. Alex looked at the second column. It was the column that resembled the future he wanted. The illustration showed a possibility in numbers precise enough to feel like a promise. It was not a promise. It was arithmetic performed on an assumption. Change the assumption, and every number below it changes too. The illustration showed what the policy could do under stated assumptions. Alex read it as what the policy would do. He signed. The withdrawals started the following month. And then for a long time, nothing happened. That is the part people leave out. There was no dramatic warning in year 3. The policy worked. A statement arrived every year showing $500,000 still in force. Alex checked that number, saw it was right, and filed it in the drawer. 11 years in, the account inside the policy held about $28,000. Not what the projection had shown, but it was going up and the coverage was intact, and Alex was busy. Confidence gets built over years by the absence of anything obviously wrong. Here's what those $400 had actually been doing. In Alex's policy, the full $400 did not remain as account value. A premium charge came off first. Then came monthly administrative deductions and the cost of insuring $500,000 on a man of Alex's age. At 37, that insurance cost was relatively low. It increased as he aged, following rates permitted by the contract and subject to contractual maximums. So the $400 covered charges first, and whatever survived went into the account. Early on, plenty survived. Then the roof. A storm came through in the 12th year and took part of it. The estimate was around $20,000, and the homeowner's policy did not cover it all. A home equity loan meant more paperwork and using the house as collateral. A credit card at that balance was a nightmare with a number attached, or he could borrow against the policy. The third circle, access. He called, and it was straightforward. No credit check. Under Alex's contract, there was no required fixed repayment schedule. The money arrived, and the roof got fixed. Borrowing against a policy is a legitimate feature, and given his choices, it was defensible. He was not reckless. But a policy loan is not a withdrawal from a savings account. It carries interest. His contract charged 8% a year on the balance. He was not required to make regular payments, so he did not. And unpaid interest was added to the loan. How a policy loan affects future crediting depends on the contract. In Alex's fictional policy, the amount securing the loan moved to a separate loan account and no longer received the same index-linked crediting as the unborrowed value. Meanwhile, the outstanding loan continued accumulating interest. A loan that asks nothing of you is easy to stop thinking about. Now, several things were happening inside the policy at once, and none of them announced itself. The credited interest was lower than the illustration assumed. In some years, the index rose, but the cap limited the credit. In 4 of the 18 years, Alex's fictional policy received no index credit. A 0 credit year can still sound like protection, and in one sense, it is. The index strategy did not apply a negative credit, but the policy did not freeze. Alex's premiums still arrived while policy charges and loan interest continued. Depending on the amounts involved, the net value could still decline, even though the index credit itself was not negative. Meanwhile, the cost of insurance kept climbing because Alex kept getting older. The loan kept compounding at 8%. It had begun at $20,000 early in policy year 12. Nearly 7 years later, with no repayments, it had grown to approximately $34,300. And through all of it, the payment never changed. $400, the amount he chose at 37, still arriving every month at 55. The payment stayed level. The costs inside the policy did not. Around year 16, a statement arrived that looked different. The projected values had dropped. there was a paragraph near the back about the policy's ability to remain in force and language about additional premium. Alex called the service line. The representative read him the current account value and loan balance. He asked whether he needed to do anything. He was told he could pay more if he wanted, and that the policy was in force. Both statements were accurate. Neither helped him understand how little margin remained. He hung up reassured, and the chance to correct the problem early slipped away. 2 years later, the notice came. The statement showed an outstanding policy loan of approximately $34,300. But the number that controlled the immediate danger was not the gross account value by itself. It was the net value available under the contract after the loan and current charges were taken into account. The current monthly deduction had risen to about $560. Even after Alex's latest $400 payment was credited, the remaining value was not enough to cover the full deduction. That shortfall triggered the policy's contractual grace period. To prevent the coverage from terminating, the insurer required a catch-up payment of approximately $4,200 before the deadline. Alex asked the question he had been holding since he opened the envelope. He had never missed a payment. The representative told him that was true. The company's records agreed. Then she explained the distinction Alex had never understood. The $400 was a planned premium. It was the amount he had chosen to pay based on the assumptions in the original illustration. It was never a contractual guarantee that $400 would keep $500,000 of coverage in force for life. Under his contract, coverage stayed active as long as the value in the account was enough to pay the monthly charges. The payment plus the account had to carry the cost. When the cost outgrew them, the coverage was in danger no matter how faithful the payments had been. There was a long pause on Alex's end of that call. Then he asked the question plainly. What exactly had he been paying for? He had paid for 18 years of genuine life insurance protection. His premiums had also funded value inside the policy. What failed was the projection that the account would grow enough to support the policy's later costs without a major increase in funding. He asked for a current in-force illustration, a projection built on today's values and today's assumptions rather than ones printed in a folder 18 years earlier. It arrived, and for the first time he read the guaranteed column and the non-guaranteed column side by side. The original projection assumed about 6.5% credited each year. In this fictional policy, the average credited rate over 18 years was closer to 3.5%. Nothing scandalous, just different. The original projection also assumed no policy loan. Neither assumption was necessarily false when the illustration was created. Both had stopped matching Alex's actual policy, a little at a time, for 18 years. The new illustration also showed that the catch-up payment would buy him time, not safety. Under current non-guaranteed assumptions, $4,200 plus his usual $400 a month kept the policy going roughly 2 more years. To hold the full $500,000 to about age 70 under current assumptions, the projection put him closer to $900 a month, more than double what he had budgeted for 18 years. His first instinct was to replace the coverage and walk away. At 55, that is a different conversation than at 37. Age alone raises the price. And Alex had developed a manageable health condition in his 40s, treated and stable, but something a new application asks about directly. New coverage might cost substantially more, provide less protection, or require additional underwriting. Depending on his health and the insurer's standards, some companies might decline him. That possibility had felt remote at 37, and one rule matters more than almost anything else here. You do not cancel existing coverage before replacement coverage is approved and in force. The gap between the two is where families get hurt. So, why does this catch careful people? Because a precise number feels like a certain number. A column running to age 100 in exact dollars does not read like an assumption. It reads like a schedule. Because automatic payments are easy to forget, the contract is long and an accurate annual statement can still be difficult to understand. Because for years, nothing looks wrong, and nothing looking wrong is not the same as nothing being wrong. And because the subject is difficult in a specific way, it asks you to picture your family without you in it. People file that in a drawer. Alex monitored whether the payment left his bank. He did not know he also needed to monitor what was happening inside the policy. Regulators have been working on part of this problem, specifically the illustrations. In 2026, revisions to the National Actuarial Guideline for Indexed Life Illustrations became effective. The National Association of Insurance Commissioners says the changes were intended to strengthen consumer protection disclosures. Regulators also continued reviewing how life insurance and annuity illustrations communicate projected performance, transparency, and comparability. Those developments did not rewrite Alex's 18-year-old contract. They mattered for one reason. The distinction between an illustrated outcome and a guaranteed result was still an active consumer protection concern. If you own a universal life or indexed universal life policy, here is what to actually do. And none of it requires you to be an expert. Call the insurance company directly using the number on your statement and ask 5 things. First, what is the policy worth right now? Ask for the account value, cash surrender value, and death benefit. They are different numbers. Second, what is draining it? Ask for current monthly deductions and cost of insurance charges. If you borrowed against it, ask for the loan balance, interest rate, and accrued interest. Third, what must be paid to keep the coverage? Ask what current projections show for maintaining it to age 70, 80, and 95. Ask whether the contract includes a no-lapse or secondary guarantee, whether it remains intact, and what conditions apply. Fourth, which numbers are guaranteed and which are not. Ask to see both columns, and request a current in-force illustration. In some states, policy owners may have a right to receive one periodically. New York gives universal life policy owners the right to request one free illustration each year. Ask which values are guaranteed, which depend on current assumptions, and whether the insurer can also show how the policy might perform under less favorable assumptions. Then ask the question that would have saved Alex years. If nothing changes, when does this policy run out of money? If you are thinking about replacing a policy, get everything in writing. Verify that anyone advising you holds a current insurance license, which you can check through your state insurance department. Consider having an independent professional review the contract. Ideally, someone paid for the review, not the sale. Understand any surrender charges before you cancel anything. Before surrendering a policy or allowing a heavily loaned policy to terminate, ask a qualified tax professional to review the actual contract. Possible taxable income can depend on the policy's basis, value, outstanding loan balance, classification, and the exact way the policy ends. Your state insurance department can answer consumer questions and receive complaints. Filing one does not automatically restore coverage, but it can bring regulatory review to how the policy was sold or administered. And nobody online telling you these policies are all a scam or all a miracle has read your contract. Alex ended up with choices, none of them clean. He could fund the policy at the higher amount. He could ask whether reducing the death benefit would make a lower payment sustainable, since less coverage costs less to carry. He could repay part of the loan to stop the compounding. He could compare replacement coverage carefully, canceling nothing first. What he could not do was go back and ask the question at 45 instead of 55. Indexed universal life is a legitimate insurance product. Owning one does not automatically mean someone was deceived, and many policies may perform as intended when they are properly designed, funded, monitored, and understood. Some contracts contain meaningful guarantees. In Alex's case, the danger sat in the space between a projection and a guarantee, and in how easily 18 years of on-time payments filled that space with confidence. If this helped you understand why making every scheduled payment does not always mean a universal life policy is safe, subscribe to Money Traps Explained. Alex bought that policy at a kitchen table with crayons on it because he wanted one promise to outlive him. 18 years later, the promise was still printed at the top of every statement. $500,000 exactly as agreed. What had changed was underneath it, in a column he never learned to read. He protected every payment. No one had taught him how to protect the policy.